Welcome to another episode of The Financially Free Investor, where you will learn information and strategies on how to become financially independent by investing in real estate, something that is not taught openly in our society today. Financial freedom matters so you can live a bigger life, retire early, and do what matters most to you. Get ready to hear tried and true methods to becoming financially free with your host, Jordy Clark.
Hey everyone, welcome into another episode of The Financially Free Investor. So today's episode is going to be a little different than most. We're airing it on a Wednesday, which we don't normally do. Yet I just thought it would be super interesting given everything that's going on in the economy today. This was a free coaching call I did. If you were listening like 20 episodes ago or whatever it was, I kind of promoted, I'd do a little webinar. It was like 30 minutes, 2008 versus 2022. What's different? What's the same? And I'll kind of go over all of this. It might be more beneficial if you guys want to just hop off of a podcast platform that you're listening to, go over to my YouTube channel, because we actually have video with slides and kind of break down the numbers. If you're driving, totally get it. Don't do that. Just listen to the audio because I still think it's very important, which is why we're basically replaying it for everyone. And then, if this resonates with you at all, please send me a text message. My phone number is 435-291-8670. Once again, my phone number is area code 435-291-8670. And I would just love to connect with you. If you want to text me the word coaching, well, I can get you on these free once a month coaching calls we have. Just, kind of state of the market. We're able to get one-on-one, ask questions, and be able to interact maybe a little bit more. Because again, the whole reason I'm doing this podcast is to help you grow to your first million and beyond, and eventually to financial freedom. I would love to make 100 people financially free in my lifetime, which is the whole reason for the podcast. So with that being said, here's a listen in on our coaching call. All right, guys. So I wanted to jump on and chat a little bit about the differences and similarities that we are seeing in the real estate market, at least here locally in Salt Lake City. From 2008 to 2022. So we'll get going on it. Perfect. So real quick, guys, just a general disclaimer. I do this just as kind of information and in just helping people learn based on my past experiences. This is not investing advice. This is definitely not tax advice or any sort of legal advice. So please go ahead and get your own advice based on those professions if you want. And I'm just going to give it to you from a real estate investor and or real estate agent. So was anyone, by raise of hands, or you can type in the chat bar, was anyone investing in real estate in 2008? I'm going to assume probably not, right? Most people weren't. This is some of the stuff that we had going in 2008. We had a lot of what were called ninja loans. So if you haven't heard of a ninja loan, you could get a home mortgage, even on an investment property, with no income, no job, and no assets. So that's what the ninja stands for. So you could literally fog a mirror and get a home loan, right? And we had those really starting, I think in 2005 is when they started becoming pretty prevalent. And people could go out and they could get sometimes 100, 110% of the purchase price without even proving or documenting their income, which is totally not sustainable. It was meant for like a niche of people that were self-employed that wrote a bunch of business expenses off, but then it just got overused, oversold, and too many people took them out, and they took out more than they bought. So they were getting paid when they bought a home. In 2008, we had subprime mortgages, which people did qualify, but they didn't have great credit scores, and it just wasn't. Subprime is less than prime. They also had 100%, 125% loan to value HELOCs. So credit unions, if you bought a house, they would say, hey, if your first mortgage, you're at 80% loan to value, well, we'll give you 45% extra. And so people are taking cash out of their house, which we're seeing today. People have used a lot of HELOCs. We'll get to that in a minute, but none of them, at least today, are 125% loan to value that I'm aware of. In 2008, another big problem we had was all of the mortgage-backed securities were packaged up and they were sold as AAA, which is the best type of investment on Wall Street, when they really had all of these, ninja loans and subprime mortgages kind of lumped in there with the people who actually did qualify, who had a lower debt to income ratio, who actually made what they said they made. Right. So that's, if you want to know more about that, you can go watch The Big Short. There's a lot in there, and The Big Short, the movie The Big Short, does a good job about that. But pull that out. Okay. And then there was a sense that house prices could never go down. Right. So I was pretty young in 2008 when this all happened, and I didn't really realize what was happening. But from everyone I've talked to, they said, we thought, prices would just never go down. And because of that, these two bottom came in: greed and the fear of missing out. So I think it's a Warren Buffett quote that says, be greedy when others are fearful and fearful when others are greedy. So in 2008, this was a lot of the stuff that we had kind of just floating out there in the real estate industry. Okay. So we're going to kind of go into a little bit more data. If you guys have any questions, please type it in the chat bar. I want this to be pretty engaging for anyone that did show up. So that was 2008. Fast forward to 2022, and I'm going to kind of go back and forth a little bit. 2 years ago, obviously we had the global pandemic. Almost every country shut down in the world, right? And because of that, every central bank, which kind of controls the monetary policy for that country, they just started printing money, right? Well, if you guys are playing Monopoly and all of a sudden, instead of when you pass go, you get $200, you start playing where you get $500, what's going to happen when you pass a property that gets put up for auction? Well, everyone's going to start bidding more, right? Then all of a sudden, instead of $160 to buy that property, it'll go up to $400 because everyone has more money, right? So that is what we're seeing right now. This is the 2022 projected annual inflation by country outlook for the entire world from the International Monetary Forum. Okay, so you can see here that some of these countries are having upwards of 60, 80, 200, 500% inflation. Okay, so we here in the United States are experiencing like 9% inflation, right? So we are still the cleanest shirt in the dirty laundry as far as that goes. But the interesting thing is, like, you look at some of these countries and like 59% inflation, that'd be like, we've experienced gas prices go up, double. That would be like almost everything doubling, right? So if you look at this, America is still not in a bad place. Just very interesting to kind of think about this as you look at what goes on in the world. Okay. So this, again, we go straight into the US's current inflation. You can see from 2018 to 2021, we were hovering right about 2%. Everything's, changes all the time. That's life. But then all of a sudden, after 2021, we just start seeing this massive inflation. Okay. we'll keep going here. This year as well, if you're a real estate or mortgage professional, you've definitely been feeling this. Even if you're shopping for a home right now, interest rates almost doubled in the last 6 months, which has doubled people's payments, right? So you see right here, most of the people buying houses, like it started to get more and more expensive every single month from 2015, an average of $1,250 a month, to we'll call it 2019, where we'll say that's $1,600 a month. Like that's a pretty big jump over a 4-year period. But then to go from $1,600 a month to $2,500 a month for the same average payment is a huge jump. And so that's kind of what we're seeing in the market right now, is there's a lot of people who, if they don't have to move, they're not moving, because you'll see most of this jump in mortgage prices came this year, right? So it's really put a halt on people buying new houses and even renting. So like if their rent's not getting raised, they're not moving. So this is an interesting chart looking at how the US mortgage rate might have peaked. So I'm going to go back to this other slide. Oh, no, I'm not. So right here, you look at the mortgage prices, right? Which basically correlates into mortgage payments. And all of a sudden there's this huge spike. Well, if we go forward into this graph, this is where we're at. Okay. So if you look at the long-term average of the US mortgage payment as a percentage of the median income, we're average right now. It has definitely been higher and it has definitely been lower, but we're currently average. The problem is it's been so low for so long that everyone got used to this being this low. So now all of a sudden it's a shock to the system that we're about average. This slide right here, this tells me that, like, I don't think there's going to be any sort of a crazy crash in the real estate market now, because we're like long-term average, right? Now, if we were way up here looking at like a 50-year average and we were like up here at the 35% mark, I'd say, yeah, we've got some really rocky roads ahead of us. Excuse me. This slide is really interesting, and I think it correlates well with the last slide, because we are undersupplied in housing. I've read different articles and different studies, but basically they all say kind of the same thing. Anywhere from 1.8 million units we're short to about 5 million housing units. So the interesting thing is we're really expensive compared to the last 5 years in everyone's mind. However, there is a large lack of inventory. So who knows what's going to happen going forward. We're going to kind of start getting into some more local data here for Utah. So if anyone's not from Utah on the call or watching this recording, that's okay. This graph shows every state. But interestingly enough, this is the state population change in 2021. Okay, so this kind of maps, this is from the US Census Bureau. This maps all the geographic relocation, right? So if someone moves from California to Utah or Tennessee to New Mexico or wherever they go for their jobs, this kind of tracks all of that, right? So all the green states, they were the top 10 states for inbound migration. All the red states lost, so they were the top 10 outbound for migration, okay? So you can see that Utah in 2021, so in 1 year, we added 2% to our population, which is super interesting because I think we're sitting right around 3.5 million people in the state of Utah. And just wrap your head around that. We have a housing shortage and we just got 2% more population growth. in 2021. So that's a large correlation of why we saw 30% appreciation last year, in my opinion, was we saw so many people coming in from other states, and we're historically more affordable than other states. So this is, again, from the US Census. This is Utah's population. So you can see this trend line. We just continuing to keep growing. Part of the reason is Utah's a pretty safe place, very family oriented, not just if you're LDS or Mormon. There's a lot of different religions that just look highly on family unit, like East Indian Buddhists. They like the family organization. So Utah is pretty family friendly, and we just keep seeing this great population growth, which is something you want to see as an investor if you're investing in a particular market. This right here is a chart of the active listing count in Salt Lake County. And you can see right here, that's pretty much the closest data point we have on this graph. We're still well below what, we normally are in the July timeframe. We're probably half of what we normally are. Now, I think I could actually probably, depending on how much time we have left after this, pull open some data that is newer than this, just because this comes from the St. Louis Fed and Realtor.com. So, so 2008 happened. And then in 2009, the Federal Reserve started buying mortgage-backed securities, right? They did this to kind of prop and restabilize up the housing industry. So this is how many millions of US dollars that they bought in mortgage-backed securities. And a one right here would be $1 million of mortgage-backed securities. So this is 400,000. I think that's $4 trillion of mortgage-backed securities is kind of what they started buying, and how much they held on to, right? So you can kind of see they tapered off a little bit, which this is important because this is also a correlation of where mortgage interest rates go. You can kind of just see, like, 2014, they just kept buying. They dipped a little bit. 2020 hit and they kept buying even more. So they were trying to taper down. And the Fed has come out and said, in addition to raising the Fed funds rate, which is what everyone talks about, which is not directly correlated to mortgage rates. This is really important because the Federal Reserve has come out and said, hey, we are going to taper off our mortgage-backed securities that we own, which is, it will affect mortgage interest rates, right? So this big spike right here, basically what happened is the Fed started buying all of the mortgage-backed securities they could in 2020, which in 2021 caused just ultra low interest rates that, like, we hadn't seen for a long time. I know a lot of people that refinanced like their personal homes at 2.5 interest rates. I personally refinanced a couple of rental properties at 3%, it was insane. Definitely not normal, but everyone got used to the cheap interest rate debt. Hey everyone, it's Jordy. Quick little blurb here, an ad, if you will, for myself. If you're enjoying this content, if it's really resonating with you, I'm going to be doing these calls once a month for free, in addition to everything else I'm doing for free. Text the word coaching to 435-291-8670. So you're texting me the word coaching at 435-291-8670, and we'll get you signed up for these coaching calls. And, if you can't make it, that's great. We'll send you a recording, but definitely don't want you to miss out on these calls. So in 2022, this is what we have, and I want to compare this to 2008. In 2022, the last couple of years, what I've seen is I've seen investors flipping new construction homes. So they'd go in, they would put a contract in to buy a new construction home, have the builder build it. They would turn around and they would close on it, usually with like a hard money loan. And they would turn around and sell it to somebody else and make $60,000, $70,000, $80,000 and do nothing. It's just because the market went up so fast, right? For the last couple of years, we've had a sense that house prices will never go down. I disagree with this. I think they can go down. I don't know how much they will go down. I think it's probably somewhere between 10 and 20% in a very short period of time. But then I think over the long period, because of the stuff we've talked about today, where we've got large demographic growth, we have a geographic border in Utah where we've got, large mountain ranges to both sides. We've got big lakes. Like there's only so much buildable land. Like long-term, we will, I think, continue to outpace the rest of the nation in appreciation. But I do think that we will probably see some declining house prices for the next year, maybe 18 months. That's my best guess. We've had a lot of people dealing with FOMO lately. Like they feel like they've missed the boat. They feel like they haven't got in. So the FOMO, the greed, I think that was all here in 2008. Here's other things that we've had for the last couple of years. We've had solid buyers with really good credit scores. So the average credit score in 2008, I think, was like high 600s, 680-ish. For the last couple of years, the average credit score has been in the high 700s. Because we've had such a run up in equity as well, almost everyone that has bought in the last 12 months or beyond, so the last 3 to 5 years, they all have an abundance of equity. So, most people can afford, if the market drops 10%, they can afford to still sell and they're making money. They're not underwater. And we have a lot of people, like I said before, that have mortgage rates that are in the high 2s and low 3s. And it is very difficult for a lot of people to give up those low rates and double their housing payment if they're not doubling their standard of living. Okay. So with all of that said, I wanted to just kind of give you guys just a fire hydrant worth of information. So you can go back and replay this and watch it and kind of digest it. But most importantly, this is what you can do to capitalize in today's market. And then I'd love to have some input from a couple of people. So first thing I would recommend doing is learn about seller financing, because there's going to be a lot of sellers that are stuck on their price that don't necessarily need all of their equity. And you could potentially buy things on seller financing with less money down and get lower interest rates than what the banks are offering today. You should invest in your education, keep hopping on calls like this, keep going to Real Estate Investor Association meetings, you keep listening to podcasts, keep doing whatever you need to do to invest in your education and learn and grow. Get around people who are doing what you want to do. Read books on investing in real estate specifically, and always be looking for opportunities, because when one comes up, you'll know it's an opportunity if you're always looking, versus if you're not looking and one comes up, you'll be like, I have no idea if this is a deal or not, right? And the last 4 are probably just as important as the rest of them. Turn off the news media, because they are selling something and you are what they're selling. So you just got to turn off the news media. Most of the time, whatever they're saying has some sort of a spin to it for their own purposes. You need to prepare for opportunities as well. And then the biggest one is, most people's wealth is created in down markets if you're open to it. Because like the Warren Buffett quote that we said before, be fearful when others are greedy and greedy when others are fearful. So right now, everyone is scared out of their mind that the real estate market is going to just completely collapse. Here's some other things that are different today, that like people had to put money down on properties. They had to actually qualify. So I don't think that they're going to be able to walk away emotionally from those houses like they did in 2008 when people were just mailing keys into the banks. People are going to actually be like, okay, how can I figure this out? How can I, can I rent it instead of just getting foreclosed on? Can I downsize and, can I sell this on seller financing and let somebody take over this interest rate? I think people have a lot more options today. And quite frankly, banks are a lot more prepared than they were in 2007. So they don't want another 2008, and they will do whatever they can to not let that happen. With that being said, though, I do think we're going to see prices come down. I think there's going to be an opportunity. And if you can buy something today that's cash flow positive, I think in 10 years, you're going to thank yourself, because the prices will probably double, if not triple, along the Wasatch Front in the next 10 years, just due to how many people we have coming in, how good our economy is. It's very well diversified. It's not like we just have one big Tesla plant that serves everybody job, like gives everybody their jobs. So there's a lot going on, but overall, I still think that now is a great time to invest in real estate. You just have to be a little bit more cautious. And the biggest thing is make sure that something is renting for more than what your payment is going to be, because you can hold that asset indefinitely. Versus if you buy something that loses $300 a month, you might be able to hold on to that for a while, but if other stuff in life happens, it's going to be tougher to lose $300 and not lose that house. So with that being said, thank you guys. Does anyone have any questions? Feel free to unmute yourself if you have any questions. If not, I'll pull open some interesting market data.
I have a question.
Yes.
Can you hear me? Okay.
Yeah.
Yeah. So, if you had to guess how long this shift was going to take place, like over what span of time frame, how many years, that we're going to see this correction and then potential bounce back, what would you guess? And I know there's outside factors like, maybe potentially who gets elected in 2024 and stuff like that. But if you had to guess right now, what would you say?
Well, you led me right where I was going. I think it's going to last less than 2 years, because politicians typically like to stay in power, and they will do something to correct mortgage interest rates or something that will kind of rebalance stuff out before 2024 is my guess, because that's a big election year. So I think like the Fed's going to stay on their course that they're on until they break something, which could potentially happen by the fall and or winter if they keep jacking the Fed funds rate up. So I think it'll be short for the most part. Like I don't think it's a depression. Plus, on average, I think the average recession lasts either 8 to 14 months is the average recession. So does that answer your question? Maybe. Okay.
Yeah, sorry, I was on mute.
Oh, it's all good.
I was trying to get off. Yes, no, that answers my question. That's kind of what I was feeling too. But yeah, thanks for that. That's helpful.
Yeah. So, real quick, and then we'll ask one more question, or we'll answer one more question, I guess. So this right here is along the Wasatch Front. You can just see the number of residential listings entered from 2018 to now. 2022 is this purple line right here. So like there's really about the same amount of homes being entered into the multiple listing service, more or less, for the last 5 years, right? Well, here's where it gets interesting. This is the average number of active listings per day by month. So this yellow bar is 2020. COVID hit in March. And so we saw a big uptick in April. And then May, it stayed pretty consistent. But then from there, people realized like, it's not the zombie apocalypse. We're not dying off by thousands. And inventory just went down really quickly compared to the previous 2 years. Well, 2021 inventory stayed ultra low. Like, this is insane how low inventory was compared to 2018 and 19. Well, 2022, April is really when we started feeling the interest rates get jacked up on mortgages. And you can see how quickly inventory has corrected itself. And we are back to 2018, 2019 levels. However, we've not like surpassed the number of available homes. And again, keep in mind, earlier in the presentation, we saw that in 2021 alone, we added 2% to our population from people just moving from other states. And that nets out everyone that moved out. So here's the other point where it gets a little interesting. This is the average number of under contract listings per day by month. Purple again is 2022. Well, we now have the fewest number of homes going under contract in the last 5 years. And our inventory is climbing. So Carolyn, going back to your earlier question, if we keep having less homes go under contract and more homes coming on the market, it's going to start balancing out even more than it is right now. And stuff's going to take longer to sit. You're going to see a lot more motivated sellers. You might see some people who just take knee-jerk reactions and take huge discounts for their house just to sell it. And if you plan on holding that house for 5 to 10 years, like the next 18 months could be a great buying opportunity for the right deal. Now, it's not just like go buy anything. Right now is the time to be looking for really good deals. Right here in 2020, like in June, July, that was the time to buy anything. Because then we had like 60% appreciation over the next 18 months. But we are not in that time right now. So, but if you can buy something that's 10 to 20% below what somebody else paid, I think you're getting a good deal. And in 5 years, it's going to make a lot of sense. So with that said, do we have one last question to wrap this up? Ryan Stone, do you have a question?
I think you kind of just answered it. I was going to ask you about inventory levels and maybe demand levels, but I think you kind of just answered it right there. So
yeah, this is where I equate demand to, where how many are going under contract equals demand in my mind. Because that's the ready, willing, and able buyers that are meeting with sellers and agreeing on price and terms. So this right here, I would say demand is at a 5-year low currently, just based on how many homes are under contract. So that also means if demand continues to stay lower than the last 5 years, which again, like you kind of have to almost factor out 2020 and 2021 because they were kind of anomalies. But if we like keep going dramatically lower and follow the trend line in October, you know, we could be selling 5,000 houses instead of 9,000, you know, or 4,000 instead of 6,000. And then that's where you're going to see, you know, like it's going to be a great time to make lowball offers in the next 4 or 5 months, depending on what happens. Like we are not making full price offers on anything for our clients right now. So now's a great time to be lowballing.
So a follow-up question, Jordy.
Yeah.
So if you are looking to do like a fix and flip instead of investing in like a long-term hold, you might see a lot more competition then because people are going to be a lot more picky about what they're going to buy.
Yep. Yeah. So on anything I'm looking at as a fix and flip, you know, if I think the after repaired value is 500,000, I'm going to shave 10% off the top of it, assuming that I'm going to have to price it at 450 to be priced the best and look the best for, you know, the given inventory in that area when I go to sell it in 6 months. And then if I still make profit at that number and it's the profit I want to make, then we'll flip it. But yeah, we're being a little bit more cautious on what we buy because of that. Like, we don't know where pricing is going to be at in the next 6 to 12 months. I'm going to guess it's 10% lower. And I'm only flipping stuff that I'd be okay holding as a rental property. If it doesn't sell, I can just refinance it and keep it as a rental. Cool. Well, thank you guys so much for hopping on this quick coaching call. I just wanted to let you guys know what was different, because so many people, I think, are expecting us to just fall off a cliff like we did in 2008. And the real estate market, A, doesn't move that fast. And B, we've got different underlying fundamentals this time versus last time. So it's going to be different. I don't think it's going to be as dramatic, where big problem is people were just shipping in their keys because they got paid to buy the property, and now, you know, they're upside down and they don't really want to make it work, versus people who actually put like 10 or 20 or 30% down, like they're going to figure it out right now. Plus they probably have a way lower interest rate. In 2007, the interest rates were not 2.5%. So, which, you know, anyone that has that, by the way, is not going to let that interest rate go, unless they have to. And so they're just going to stay in their house, which is not going to solve our inventory problem. So I don't think we're going to see a flood of inventory. Okay. Well, my one ask for you guys is, if you haven't subscribed to the podcast, please do. And then take 5 minutes to debrief in your mind and write down 3 things you learned that you can implement in the next 90 days in your personal or investing journey. So with that being said, guys, make it a great day.
Thank you. What's the podcast called again?
The Financially Free Investor.
Okay, awesome. Thanks, Jordy. Appreciate it.
I'll send you a personal text message with the podcast.
Awesome. Thank you.
Okay.
See ya.
See you guys.
Bye.
Thank you for joining me for another episode of the Financially Free Investor. If you found value in this episode, or know someone who would find value in this information, please share with them, subscribe, and send us a review.